there are 4 ways to make money. Only 4. If you take none of those 4 risks, you make no return.
Since the early days of his career, hedge fund manager Mark Yusko invested in the technologies that would revolutionize commerce and media. Today, Yusko is convinced that those innovations were only the prologue of a much larger revolution that will disrupt the financial system.
And the internet of value will be bigger than the internet, will be bigger than the mobile net. Why? Because as Newton said, we stand on the shoulders of giants.
But as history has already shown, the more disruptive the innovation, the bigger the forces opposing it.
The incumbents really don't want the disruptors to win. So they will fight really hard. They'll throw up regulatory barriers. They'll try to buy up the companies and shelve the technology.
In the struggle between innovators and conservative forces, which side will prevail? And what are the assets that will define the future financial system? Find out in another exclusive Cointelegraph interview. First of all, I would like to know a little bit more of your background. So, as many Bitcoin supporters, you have a past as a skeptic. So, how did you transition from being a Bitcoin skeptic to a Bitcoin believer?
Yeah, it's actually really interesting in that had I been less skeptical, I'd be a lot wealthier, but that's okay. So look, my history goes way back. I came out of school, business school, went to work for an insurance company, managed bonds, and worked for an equity firm. Then I kind of went back to my alma mater, worked in the endowment world, and the endowment model really taught me all about investing in private investments, particularly venture capital. And I had this aha moment in 1996. We invested a little bit of money in this little company called Google. $500,000 turned into 200 million. I joke there should be a quad at Notre Dame called the Google Quad. And essentially what that did is it made me realize that infrastructure around these technological innovation waves really matter. So fast forward to 2013, I had invested with a friend, Dan Moorhead, in his macro fund when he spun out of Tiger. And he called me up and said, hey, come to San Francisco. I want to tell you about what I'm going to do. And went out there and he said, look, I'm going to shut down my hedge fund and I'm going to spend the rest of my career focused on Bitcoin and blockchain. And I'm like, look, I wasn't running drugs on Silk Road. I was not a cryptography student. I didn't know what Bitcoin was in 2013. Unfortunately, I joke, the Winklevoss twins and I were introduced to Bitcoin about the exact same time. They're multi-billionaires. I'm not. So be it. Now, I also defend myself saying I didn't have $500 million to put into it, but I had something, but I didn't do it because even though Dan had conviction about it, I was skeptical. I didn't really understand. Now, what I did understand was infrastructure. So investing in his early funds has been great. Those funds are up 11, 12x. I think now more with the FTX deal, but that pales in comparison to the Bitcoin fund, which is up 350 times, best performing hedge fund in the history of hedge funds. So the short version of a very long tale, a lot of people have heard it already, is about 9 months later, I wrote one paragraph in a letter to investors, 40 pages, one paragraph saying Bitcoin might be an interesting special situation. Maybe throw a few basis points in, price was $500. I got hate. Giovanni, I got hate from my clients. I mean, like, we'll fire you. Don't talk about this stupid stuff. Go back to doing your job. It's like, wow. I mean, that is a violent reaction. So now what's interesting about that, the skepticism was quote unquote proven right in that the price fell. Over the next few months, the price went from $500 all the way down to $185. And of course I said, oh, see, everyone was right. Well, no, they weren't right. Price is a liar. Stole that from John Burbank. And the value kept accreting. The value kept going up. So that was 2015. 2016, I finally got over the skepticism. Why? Because I did the work. I actually spent a year diving deeply into the technology, reading the white papers, really looking and talking to other people. And I had this aha moment. I mean, I couldn't make this up. I was literally behind the wheel of an RV in Eureka, California. And it hit me that this is simply an operating system. The blockchain technology is an operating system for the internet of value. And the internet of value will be bigger than the internet, will be bigger than the mobile net. And Bitcoin and other things are going to power that. Other cryptocurrencies are going to power that. And so finally convinced some clients to go in. 2017, finally took the really full plunge and formed Morgan Creek Digital, a subsidiary of Morgan Creek Capital. And over those last 4 years, I went from spending 5-10% of my time on this to now close to 100% of my time.
I would like to point out the fact that you have always been keen on non-traditional investments, which is the endowment model of investing, which is something that you have been promoting for most of your investment career as a strategy of investment. Maybe can you guide us through the key points of this investment model and what role do digital assets play in it?
Yep. So, you think about the endowment model, and it's a little bit misnamed. It really should be the multi-generational model because, multi-generational families have been following the same model for centuries, as have pension funds and other big asset owners. And it's really pretty simple. It focuses on a handful of core concepts. One is a value discipline, right? You want to buy things that are cheap and hold them for long periods of time, where price catches up to the value. Second is you have to be global. You can't, all the smart people don't live where you live, right? People in America think all the smart people live in America. People in China think all the smart people live in China. People in the UK think all the smart people live in the UK. It's just not true. And in fact, if you look at investment styles, people in America have more US investments. People in China have more Chinese investments. People in the UK have more UK investments. That makes no sense, right? It makes absolutely no sense. You should have a global portfolio. Third is you have to have a diversified portfolio. And if you take cash and you add bonds, bonds are riskier, meaning they have credit risk, okay? Your portfolio risk doesn't go up, it goes down. When you add equities, which have default risk, not default risk, have bankruptcy risk, your portfolio risk doesn't go up, it goes down. And so that construct means uncorrelated assets that you add to a portfolio add incredible value. Last piece is that there are 4 ways to make money, only 4, right? If you take no risk, you get the risk-free rate. So you have to choose one of 4 risks or all 4 risks. You can take credit risk, buy bonds. You can take equity risk, buy equities. You can take illiquidity risk, buy private investments, private equity, private real estate, private energy, private debt. And you can use structure, which is just a fancy term for leverage. So if you take none of those 4 risks, you make no return. So you have to choose which risk. Well, the best risk to take, in my mind, is the illiquidity risk. So if you look at the best investors in the world, they are constantly overweight private investments, particularly innovation-oriented investments like venture capital. Yale's at 23%. You look at Jeremy Grantham, his private foundation's at 40%, 40, and they are the best performing large portfolios around. And so why is that? Well, it's because innovation is an asset class. Innovation creates the businesses that create the stocks, bonds, currencies, and commodities. So without innovation, we can't generate new wealth. Printing money does not create wealth. Never has, never will. Bad idea. So where does Bitcoin fit into this whole construct? Well, it's the perfect uncorrelated asset. All of these alternative asset classes over the years, whether it was international stocks, they're going to diversify your portfolio, but they're 70+% correlated. Hedge funds are going to diversify your portfolio, but they're 40 to 50% correlated. Bonds will diversify your portfolio. They're still 30% correlated. Bitcoin is 0.15 correlated to stocks and 0% correlated to bonds. It's the perfect diversifier. So if you add it to a portfolio, your risk goes down and your return goes up. It's the perfect diversifying asset because it has asymmetry of upside versus downside. So it's a great asset. The second reason, it's the ultimate innovation, right? Bitcoin is an innovation in money, right? Gold is the only money in the world, right? Everything else is just credit. And every other currency in the world has an associated liability, government debt. Gold is the only asset that has no liability associated with it. That's why for 5,000 years, an ounce has bought a fine person suit, right? Suit of armor, zoot suit, fine man suit on Savile Row today, fine woman suit. Okay, it is the ultimate store of value, but it's not very portable and it's not very divisible. It's really hard to break a bar of gold so I can give you half of it. So Bitcoin is better, and it's digital. And as we move from the analog world to the digital, from the electronic world to the digital world, it is the perfect money. So for all those reasons, innovation and a diversifier, you have to have it in your portfolio. And that's why I have the hashtag #GetOffZero.
Cool, but just to make sure about your position regarding all this crypto space, when you talk about Bitcoin, you talk about the leading example of an overall innovation movement that is happening in the world of digital currencies, or you are truly a Bitcoin maximalist that thinks that the only value is in Bitcoin?
Yeah, no, thank you. So look, I am not a Bitcoin maximalist. I think Bitcoin is a fantastic asset. I think it is hard money, the better form of money, but I think tons of other protocols are going to be great. I think we're going to have a protocol stack for Web3, the same way we have a protocol stack for Web2. Today we have TCP/IP, which you and I are using right now to communicate. Then we have SMTP for email, HTTP for websites, FTP for files. Then we have www that kind of ties everything together. That's a beautiful protocol stack. In the future, I think Bitcoin is kind of the base layer. I think on top of that, we got Filecoin to do the file stuff. Now in the middle, right, we have Solana and Polkadot and Cosmos kind of vying for those middle. Maybe one of those will win or two of those will win. And then I think, Ethereum is the www at the top that ties everything together as a toolkit. So I think you're going to have huge opportunities in Bitcoin. Not as huge as they were 5 years ago, but still huge. We'll talk about that, I'm sure. Then I think you even have bigger opportunities in Ethereum because it's a toolkit and more things will be built on that. And the nice thing about Ethereum is there's a business model where you can actually share in the revenues. One of the challenges of a store of value asset is it generates no income, right? It's just there to store value. Then you've got all these other projects, things like play to earn, things like gaming, the metaverse, NFTs. NFTs are going to be absolutely monstrous. I mean, people just don't understand what tokens are. So what the internet did to information, commerce, now blockchain and crypto does to financial services and to value. And so we have tokens today, very small number. In the future, we'll have billions, maybe even trillions of tokens that will represent digital ownership of every asset, every stock, every bond, every currency, every commodity, every piece of real estate, every piece of art, everything. It will be trillions. Everything will be tokenized.
I totally